it really shows the importance that you need to save before investing, and we need to save with the intent to invest. Now, the question is, where do we save? And it's always a give and take. Most of the time, people feel like when we're saving, we have to kind of choose between saving in a savings account where we're ultimately losing money to inflation, and so that's the give and take. You're slowly going broke because the money in your savings account this year, if you're earning 0.1% and inflation is nearly 8% right now, that means if you have 100 grand in a savings account, you're basically losing $8,000 of purchasing power. That kind of stinks. Hey, what's going on, cash flow hackers? It's Chris with Life 180, and for this video, I want to talk to you about why whole life insurance is the best storage tank for your capital to protect yourself. And I always say it's an inflation hedge, right? And what I want to talk about in this video is the fact that, listen, we all need to keep money liquid, accessible, controllable if we want to be successful with our money. If you haven't seen my financial pyramid video, my Life 180 pyramid video, talking about the way that we design our life, our financial life, it really shows the importance that you need to save before investing, and we need to save with the intent to invest. Now, the question is, where do we save? And it's always a give and take. Most of the time, people feel like when we're saving, we have to kind of choose between saving in a savings account where we're ultimately losing money to inflation, and so that's the give and take. You're slowly going broke because the money in your savings account this year, if you're earning 0.1% and inflation is nearly 8% right now, that means if you have 100 grand in a savings account, you're basically losing $8,000 of purchasing power. That kind of stinks, right? Like, nobody wants to do that. But the problem is, a lot of times you're stuck. You feel if you run a business and you need reserve capital, if you're a contractor, if you're a developer, if you're a real estate investor, you need access to liquid capital. And so you kind of feel like you're stuck between a rock and a hard place because you need the liquidity, you need to be able to access that money. And so where do you put it? Now, on the other side of things, the other two assets that people typically put their money in for guarantees are CDs and bonds. And quite frankly, you lose the liquidity in those assets. And so while you get the guarantees, the give on that is that you lose liquidity. And so I would argue that by losing the liquidity of that money and not being able to access your capital, the rate of return in those to get the guarantees are not nearly high enough to warrant giving up control of your money, because control is a huge component to your financial success. And what I want to do in this video is kind of walk you through a little bit of history and talk about why I believe whole life insurance, when you design it properly, is the best storage tank for your capital long term, that any money that you need for reserves, for emergency, for opportunity, whether you're a real estate investor, whether you're a contractor, any of these things, whole life insurance is where you should be storing your capital, and I got proof for you. So let's just take a look at this graph. Now, so taking a look at this graph, what you can see here is it goes back to 1920. Now, full transparency, this graph is a company that I don't represent, that none of the people affiliated with Life 180 can access. It's Northwestern Mutual. This is just the best graph that I could find out there from a company that showed this picture without me having to recreate something. Now, Northwestern Mutual is a good enough company. They're not a great infinite banking company. However, what I will say is what they do really well is what this image does really well is that it shows kind of the dividend scale history. Now, all of the mutually held life insurance companies, the participating mutually held life insurance companies, their dividend scales are usually within about a percentage or so of each other. And so when you look at this long-term, from a long-term perspective, you can see the fact that inflation typically follows, or there's a little bit of a tail, but you can see that the dividend rate will typically catch up, and it makes up for inflation. So you can see, like, a good thing to look at is in 1970 all the way through 1980 and 1990, you can see the dividend rates going up and up and up and up and up. Now, this is what excites me about the current environment that we're in today. If you're looking to keep your safe liquid capital inside of an account that is going to be protected against inflation, That's why I love real estate, because real estate has got a complete inflation hedge because it's a physical asset. But when you combine it with whole life insurance, the storage capital that you're keeping your money in there for opportunity for your real estate investments also has an inflation hedge to it. And history goes to show this. So you can see in the 70s when inflation started getting bad, the dividends started to grow. Why is that? Because as inflation goes up, so too does the fixed market, because they need to raise interest rates to be able to incentivize savings, to be able to get people better returns. They just have to. It's the way our economy works. It's the way the Federal Reserve and the fractional reserve banking system functions. And so you need to understand these things if you want to take advantage of it. Now, dividends got as high with Northwestern Mutual there. I think it looks like they only got up to about 12%, but I know other companies that got up to 14.5% dividend. And in that situation, you can see here, inflation got as high, it hit its peak in 1979. And I always tell people there's a tail to whole life insurance companies keeping up with inflation. It's going to be a good long-term hedge. However, this year, if your dividend right now is 5% and inflation's 8%, yeah, you're still losing in a whole life policy if your real return is, say, 3.5%, 4% after all expenses and fees. But guess what? Next year, the year after, we don't know when it's going to happen, but eventually the market will catch up with itself. And what I know is that no company, no industry, no set of company, no group of companies are better than mutually held life insurance companies at managing risk with the focus on preservation of capital. And preservation of capital takes inflation into consideration, and because they're trying to preserve the purchasing power of your capital. That's what makes them so amazing at what they do. And when you look at this graph, it shows you here, like I don't know, 1979, this is when inflation got absolutely the worst and it started getting under control. But what did they do? The dividend rates started scaling up from 1984, 85, 86, 87, 88, 89, 90. And what happened is where it lacked in 79, 80, 81, 82, where it was behind the inflation rates for 3 years or so, 84, 85, 86, 87, it was beating the inflation rate, so it made up for it. So life insurance companies know how to manage this to make up for it. So we have to think with a long-term view. And it's the same thing I talk about taxes. Taxes, we have to think with a long-term view. People make the, I think, catastrophic mistake where they're trying to get a tax deduction this year by utilizing a 401k or a qualified plan. But what they don't realize is that they're not avoiding taxes. They're not really getting a pure deduction. They're getting a tax deferral, and they're going to have to pay taxes down the road in potentially what is likely to be a higher tax rate environment. And so by thinking long-term, you can manage your lifetime tax liability more effectively. The same goes here. We have to think about how to manage the best storage for your safe capital, the money that you need liquidity, use, and control of. You need to hold that inside of a whole life insurance policy, because of the fact that when you design it properly, you can keep liquidity of that money, you can have high cash value in that money, accessible, and it's going to be a hedge against inflation. It's going to preserve your capital, and it's going to protect the purchasing power of your money for the duration. And there's no other, quite frankly, there is no other account in the world that will provide that for you. So I don't know about you, it's a pretty good deal in my eyes. So that's a really good, really simple video for you. I just wanted to get that point across. I wanted to show you that. If you have any questions at all, comment in the comment section below. By the way, if you haven't already, go check me out on other social media platforms. I'm starting to create more shorts. They're going to be up here on YouTube Shorts, but I'm also going to be sharing them on my TikTok page, my Instagram page, and my Facebook page. So if you're more into those platforms for short content, if that's kind of your jam and you're not really used to the YouTube Shorts app yet, I would really encourage you to check me out on those other platforms. I'm going to be creating a lot of content there as well, just to bring more value to everybody and reach you where you are. And so that's it. If you have any comments, comment in the section below. If you haven't already, smash that like button, subscribe, hit the bell, all that fun stuff. Until next video, have a blessed, inspirational day. We'll talk soon. See ya.